You're listening to Working Capital, the real estate podcast. My name is Jesse Vergali, and today I have two awesome guests on the show, Kristina Knight and Charlie Stevenson. Hello, Kristina. Hello, Charlie.
Hey, Jesse.
Hey, Jesse.
Thanks for having us on.
Yeah, excited to be here.
Thanks so much for coming on the show. First of all, how's everything going right now? I know 2020 has been quite the year, regardless of the industry you're in.
Yeah, it's been going fine, actually. We just ended up focusing on other things than we originally thought. So we kind of just shifted focus, and we've kept ourselves really busy by doing that and creating value for the business and investors by doing so. But it's different than we originally thought when we sat down in January 1st and said, all right, here's our goals for 2020. This is what we're going to do. It was like, a month and a half later, total switch.
Yeah.
Awesome.
But I'd say we've been focusing a lot on processes and systems and brand development and
capital raising.
Investor reach out, all those things.
Getting everybody prepared for the hopefully upcoming opportunities.
Awesome. Maybe before we start, I've heard both of you talk on different podcasts, so I have a little bit of a handle your background, but for listeners, between the two of you, if you could just go into a little bit of kind of your area and how you kind of got on this crazy journey of real estate that we're all a big fan of.
Sure.
Yeah, sure. I'll start. So I actually spent over, a decade in the investment management industry, as a portfolio manager, trader, research analyst, and my focus was on mortgage investments, the housing industry, commercial mortgage investments. And so I naturally had a really big background in real estate. I just wasn't investing. And then, in 2014, we bought a condo, our first condo, and we ended up renting it out. And that kind of started the real estate bug. And when we were kind of thinking about where we wanted to take our business and, long story short, we kind of stumbled upon real estate because we were already making such great cash flow from the condo that we owned in Boston. And we kind of had this aha moment, like, well, what if we, did this time and time again? Like we could, create a life of our dreams and have the ultimate freedom that we wanted.
Yeah. And that aha moment came while we were traveling across Mongolia across Russia on the Trans-Mongolian Railway. And tying it into my background, I was an entrepreneur. I started a couple of adventure travel businesses out of college and grew those over the course of time based in Italy. And we met and are married, actually, if just for that context. We don't just do everything together.
Just note that. Yeah.
Also got married. And so I always loved traveling. And I was in the corporate world while I was, in the corporate side of my career while she was doing the investments thing. And we were both kind of feeling a little bit kind of bored, I guess, for lack of a better word. And that's when we decided to go on this trip, which is when we rented our condo, which is when we discovered cash flow and why we were sitting on a train in Russia, having that aha moment about what if we had 10 of these? If we had 10 of these, we could literally retire and continue on this train if we want. But we then realized that it was more than just buying condos. It required a whole business around. She was actually on the train with us too, I'll say. And from that point onward, which was about 3 years ago, we started acquiring multifamily properties, starting small and then growing bigger and bigger until we started. Our first one we bought was a 4-unit, and our last one we bought was, we bought a 324 unit and 111 unit. So
it'd be nice if, there could be a little improvement there. 4 to 300. That's fantastic. So it sounds like, and correct me if I'm wrong, I usually tell whether it's clients or investors that the good teams, the good partnerships have complementary aspects to their backgrounds. And it sounds like Kristina, very analytical from the finance world, and you, Charlie, seem like the entrepreneurial creative. Is that fair to say? Is it a little bit of the Dionysus and Apollo?
Yeah, I'd say like I'm kind of starting businesses, you end up learning how to fail, and you end up learning how to fail quickly so that you can then take those learnings into your next business or iterate that business. And so basically as an entrepreneur, I've failed a lot. And so I bring that into, our current successes, and so systems and processes, raising money, thinking about branding, thinking about marketing and sales. I'm kind of a generalist, whereas Kristina is, the analytical powerhouse, as is our other partner, Lin Ying. They're the ones that really understand the numbers. I'm just kind of like along for the ride.
Well, you know what? It's interesting. We had Whitney Sewell on the podcast about 2 months ago, and I heard Kristina, you were talking about asset management, and I definitely want to get into that. But before we do, I'm just curious, the first condo, like that aha moment, what were a few of the details of that, like in terms of, when was that, what year was that in that you guys started with that? And what was the reason that deal was the one to be like, oh, wait a minute, we can actually potentially make a living doing this?
Yeah. So, we bought the condo in 2014, and it, it was in a really prime location. When I bought it, I always had the intention of, someday this might be a rental, and I want it to be really easy to rent out. So that was definitely in the background. And the other thing was, I wanted to make sure that the mortgage payment was low enough so that if I did rent it out, I knew I could absolutely cover my mortgage, and possibly make some income on top of that. And so that was kind of the thesis behind like getting started with that. And we bought the location was within like a 1-minute walk to a bus stop, 5-minute walk to a subway. Like, you could walk downtown in 25-30 minutes. So it's a really attractive location. And I think at the time, the mortgage on that was around like $2,200, and we ended up renting it out for a little bit over $3,000. So after like taxes and HOA payments and everything else, it was generating about $800 in cash flow a month. And it was a brand new building, so there wasn't really any maintenance or CapEx or anything else that really needed to be paid for aside from the HOA. So
it was also in Boston, in a nice neighborhood in Boston. And so we knew that it was going to continue to grow in value, which was a big part of it as well. So the location was really solid because Boston's got a really diverse economy, lots of people that want to rent and buy. So we knew that was underpinning the kind of investment itself too.
Yeah, for sure. And it's we get a lot of people that come on the show that buy in kind of tertiary markets on the multifamily side. And it's always interesting to hear a little bit on the condo side, because I'm a city boy, and our prices in my area are extremely high, over $300,000 a unit. So a lot of times, whether, you're just getting into real estate, sometimes condos, they can be the perfect fit. And to your point, we joke around, they're built like prisons. So it's really hard to do that much damage to a condo. Not that it can't be done, but yeah, definitely a good kind of foray into real estate. So maybe what we could do here is, most people that come on, we have a bit of a segment where we go a bit of a in the weeds, a deep dive into an investment. And I usually let the guests choose the investment. So if it's, whether it's one that you've recently done, your first one, or anything in between, be happy to hear about that and how you acquired.
Okay. Yeah. So I think probably one of the more unique investments that we did was actually our first deal as Akras Capital. And that was a 4-unit and a single family home that we purchased from a wholesaler in one transaction. And so, we actually just sold the property, but it's interesting because it was, purchased from a wholesaler. It was it ended up being a fix and flip, a long-term hold. It had seller financing. It was off market. It came with a whole host of, issues that we had to learn from and deal with. And, so for new investors out there, for people that are, looking to scale their real estate career, I think it has a lot of lessons in that deal.
Yeah. And I was just writing a post for Bigger Pockets about it, just going soup to nuts through the whole thing. And it's kind of like we were trying to figure out what the title was for this thing. And it has all these different components. And I'm like, let's just call it the ultimate first multifamily deal, because it has literally everything. There was, scary situations with gas lines getting, struck. There was lots of big wins. We were able to refinance it and take all of our money out for a cash on cash and infinite return. We sold it during COVID for 350% return on investment. So it kind of had a little bit of everything, and it was a fun article to write. And we'll have that on our website. So you guys.
Wow. So this was pretty recent. If it was during the shutdown.
Yeah, the exit was just in the last couple of months. We purchased it 18 months ago or 20 months ago or something like this.
And where was that property located?
It's in Washington State, and the second largest city in Washington is called Spokane on the east side of the state. It's where I'm originally from, and so we chose that market for that reason. We had some familiarity with it. It had a lot of tailwinds from a growth perspective. So it's an inland city, and a lot of people from Portland and Seattle and San Francisco have been moving inland off the primary coastal cities because it's less expensive, higher quality of life. And Spokane was one of those cities that was kind of a recipient of all that growth. So we liked the market for that reason.
And what would be kind of the stabilized, once rent stabilized, what would be the value of a property like that in that area?
Yeah, so just to dive a little bit deeper into the details. So we bought the property for a little less than $350,000, and it came with the 4-unit, which in that location was worth $350,000 in and of itself. But it also came with a single family home that had never really been updated. The place was a total dump. And so
it was an adjacent to the actual multifamily.
Okay.
So it was being traded as a fifth unit.
Yeah. But the thing that was interesting about it is the deal would have never worked had you run the numbers and not come up with the idea that you could parcel off the single family. So the property actually under the sale price came with 2 parcels. But no one had ever thought to split them because they were connected with a natural gas lines. And so we had to, get really creative and work with a bunch of different contractors and figure out, okay, how do we excavate this? How do we split the natural gas so that if we want to sell off the single family home as its own separate parcel, we can do that, which is exactly what we did. So that was kind of interesting, a lot to take on for your first deal with the 4-unit and a fix and flip at the same time. Really, it was 2 deals in one. And, we learned a lot. We ended up selling, so we bought it for $350,000. We ended up selling the single family home for a little over $225,000. And we just sold the 4-unit for over $430,000 from a $350K purchase. So
awesome.
Yeah.
That's great. You know what? Yeah, you're right. I feel like most people are looking at aslaides of plans, not usually of gas lines on their first deal. So that's that's pretty sweet. And in terms of the wholesale, so for listeners, that was somebody that was assigning the contract. Was it an assignment, or did you kind of double close on it? How did you work that out?
Yeah, so it was an assignment of contract. The other interesting part is we were able to negotiate seller financing on the deal.
Oh. That's just the gravy on top.
Yeah. So we actually were able to talk the seller into carrying the mortgage for 12 months. And on top of that, he had an underlying mortgage still on the property. So it was a wrap over, that. And we were able to convince him to charge us 0% interest on the balance over his current mortgage. So definitely a lot of negotiation skills there from especially back in the investment and trading days. And it worked out really well because we were then able to refinance.
Sorry, go ahead.
Yeah. We were able to refinance it 10 months later and, appraise it for almost, just the 4-unit for what we paid for it and pulled all of our money out and then some of the deal.
Wow. Okay. So you guys are clearly sharks. The vendor take back mortgage. That's interesting that for those that don't know, and this is pushing my knowledge a bit too. You mentioned a wraparound mortgage. So the wraparound would be in second position to a mortgage that you got with the bank. And then you had 2 of those obligations.
Yeah. Right. Mm-hmm. And then we had one escrow company that paid both. So the escrow company paid the underlying mortgage to the bank, and then they paid the seller the balance.
So I know that Kristina, you being kind of in the finance world, I know you have an IRR on this property. Do you have did you have a ballpark that you were looking for a return on investment for it, or are you looking at purely a cash on cash?
Yeah, so we were purely looking at cash on cash. Our goal was to kind of generate that infinite cash on cash return after refi, which we were able to do. We hadn't really considered, our original plan was to hold this investment long term. But as we've grown and scaled, up, we've realized that it's so much easier to operate buildings like under one roof. And so we've kind of been in the process of consolidating our portfolio a little bit and selling, and then being able to stack up and trade up into bigger assets, just to make operational efficiencies easier. I knew like our original target was to have, the value of the 4-unit, increase to at least 375,000. So that was kind of the target. We ended up selling it for almost over 50K over what we originally targeted. During that 18-month period, we were able to increase rents on the building. When we purchased it, rents were only about $2,100 a month for the 4-unit, and during a 1-year period, we brought them up to over 3,300. So quite a significant increase from our business plan.
Yeah, that's great. And you mentioned it, and Charlie, you did as well. Could you just explain to listeners, when you say an infinite cash on cash return, could you just kind of explain, the framework and what you mean by that?
Yeah. So essentially, when we purchased the deal, we put about $50,000 down. So we had $5,000 to the seller, and then we had to pay a wholesale fee on top of that to the wholesaler. And then when we refinanced the deal, we were able to get all of our original investment out and then some. So we actually ended up taking an additional almost 10K out on the refi as well. So essentially, we had $0 of our own capital left in the deal. So what that means is anytime you get a rent payment and you have cash flow generated every month from rent collections, that money is essentially an infinite return, because whatever dollar you make, it's over the $0 you have invested in the property.
Yeah, I went a little hazy there, just thinking about math in high school. Is it undefined? Is it? Yeah, that's. Well, listen, that's a very awesome. Yeah,
this is why I like her because I'm also kind of getting a little blurry listening to it.
All right, well, let's take us back to reality here. That's a fantastic deal. Congratulations on that. And maybe Charlie, you could talk a little bit about Akras Capital, and clearly you have made strides within the where the portfolio is at today. Why don't you just fast forward us to today and maybe talk a little bit about that journey and like I said, Akras Capital itself.
Yeah, so we began acquiring those smaller multifamilies in Washington State. We acquired 3 of them, and Kristina focused on asset management. I focused on kind of business strategy and capital raising and investor relations. And then our other partner, Lin Ying, focused mostly on underwriting, as she had a lot of experience in that. As we began operating those 3 assets, as Kristina alluded to, we realized that there was a lot of work in operating assets, even with a property management team in place. And we early on began developing a stable of mentors who had experience in real estate investment and development. And all of them were basically like, you guys, like, why are you dinking around with these small multifamilies? Like, go bigger. You need to go big or go home, essentially. And we're like, no, we want to learn. We really want to take our time with this, start small, and kind of ladder ourselves up so that we aren't just jumping right to a large asset and getting ourselves in over our heads, because we hadn't brought any investors except our own capital into these deals yet. And we wanted to be really, really careful at that moment when we did. And so we finally took their advice and started going to some different conferences that introduced us to larger deals, syndication, larger asset management, and met some partners who had already had a lot of experience in acquiring and operating larger multifamily complexes, mostly in Dallas and Fort Worth and Orlando, Florida. And basically asked them to show us what they could. And they were happy to see us because we had a lot of energy and could help to generate deal flow for them even. And that's when we began really studying syndication and in a more intentional way. Since that point, we've been the general partner on a couple of these larger multifamily acquisitions, which we continue to operate today, and now focus all of our efforts on 75 to 300 unit multifamily acquisitions, just because there's so much more efficiencies to gain when you have an on-site leasing office, when you have a more systems-driven, larger scale property manager to help you to have all those efficiencies. And so, frankly, for Kristina, life is way easier with these larger, units as the asset manager. And that's sort of where we are today, is working to grow our portfolio and our experience in that regard.
And right now we're focused on looking at the Phoenix market. So we've moved away from Washington and are focused on Phoenix. We really love that market right now. It has super strong fundamentals, strong job growth, diverse and economic and employment base. And you're seeing a lot of people move there, especially from the coastal cities. So I think the outlook for that market is really strong, and that's kind of where we're focused there right now.
So our thesis has remained the same, which is inland growth cities and investing in multifamily Class B value adds. But our markets have changed a little bit, and our focus on growth has really been, pushing us towards those larger assets. So.
So there's a lot there, and I'm gonna try to start sequentially here. But so there are a number of individuals that are looking to move from the space of using their own capital, and just like yourselves, we're probably a little bit whether it's scared or just intimidated by it. So going to whether it was coaching or going to different seminars and meetups, at what point did you realize that you could actually be the GP and operator and felt confident in doing so? And in addition to that, once you know that, which pool of individuals did you go to when you're kind of, switched on into raising capital mode?
Yeah. So I think, we always had the intention to want to bring in investor capital, right? So we knew that from the beginning, just based on, education and books and podcasts and everything. But we wanted to really start with our own money first and build our own portfolio and track record so that we did know what we were doing and we could take, feel comfortable taking money from investors. And so I think the GP stuff started after we went to a few conferences that had to do with syndication and really meeting solid partners that really became great mentors for us. And then, on top of that, we took on, doing our own education. We attended multiple boot camps and read multiple textbooks and, having, I think, the investment background that myself and our other partner does, I felt really comfortable, knowing how to underwrite and look at investments and, be able to talk to investors about those investments and about those deals. So I think that, kind of gave us a leg up to get there a little bit quicker than a lot of, some people might have a higher learning curve there.
Yeah. And as we began operating our first multifamily, our first kind of larger syndication, actually it was our second when we got more involved in that regard, we kind of saw what the lead sponsors were doing, and we were heavily involved in kind of some of the day-to-day stuff. And we realized okay, this is not that different from
not rocket science.
Our smaller stuff. Yeah, it's not rocket science. I mean, there's certainly more complexities, and there's the decisions are spread across, 100 or 200 units versus just 4. But a lot of the fundamentals were the same. And Kristina, quickly showed, performance in that regard. And so we felt let's keep doing this and start doing our own. We don't need to be just a member of the GP. We can be the lead sponsor, within, in the near term.
So with those deals, if I hear you correctly, you were co-GP on a couple deals. You kind of saw what the operator was doing. Were you at any time in that learning curve? Were you on the other side? Were you a limited partner on deals?
We were also a limited partner as well.
We did both. So we'd co-invest our own money as members of the LP, and then we were members of the GP, helping to operate those assets.
And just because we don't hear as much, we had Brian Burke on the show talk a little bit about kind of the other side, the investors, the limited partner, which I feel like gets short riff because people always want to talk about the GPs. But on the LP side, did you find that you also, what did you learn from that side of the deal that helped you, moving from that position and doing operating your own deals?
Yeah, I mean, I think when we were the GP and the LP on these deals, we were taking part and involved in the conversations about how to communicate with the LP so that they understood how the asset was performing and felt good about their investment. And then as an LP, we also were receiving those communications. And so I was able to see, and in some cases responsible for those communications. So I was, I wasn't sending emails to myself, but I was sending emails to our investment team.
Yeah.
The same stuff that I'd be sending to myself as an LP. And we were able to watch our, mentors really artfully and in really intelligent ways communicate with the limited partner base. And so I really learned from them how to just, give solid updates on asset performance without, any emotion, with, in a really clear and authentic way. And so learned a lot about how to do that and what it's like to be the person receiving that kind of communication.
But I think, as an LP, like there's so much you can learn, you're receiving, if you have a strong operator, hopefully you're receiving, monthly communications on how your investment is going. You're receiving financials on the property. You're able to look at the overall deal and analyze it yourself. So I think for anyone also like looking to get into syndication, being an LP is great because it gives you a lot of experience in terms of like, okay, how do I look at this investment? What are some things I should be, questions to be asking? What is kind of the risks involved here? And so it has you start, being able to think about like investments in a different way.
Yeah, as you prepare yourself to potentially bring deals to your own investment group, as an LP, you're learning all of that. You can watch, the webinars and model your own webinars for future deals you do off of the operator if they did a good job with it, and also learn what's not going so well and make those improvements for your own operations once you are, leading your own deal. So
yeah,
there's a lot to be learned as an LP.
Yeah, it's very cool. And you know what, you basically what you're saying is what I hear a lot from people that come on the show. It's that when you mentioned that one of the colleagues said, what are you doing with these small unit deals? It's like, that's great, you still want to do those to kind of learn the industry, but usually once you kind of break into the larger deals, you're like, wow, I didn't know you could just do this, that maybe not that easily, but that it wasn't a black box. It wasn't just, something that nobody else can do except a few people. And you start realizing that you can buy bigger deals. I want to talk a little bit about the raising capital piece. So you're now in this space, you've done, whether it's, different coaching, different seminars, and now you're literally looking for your first deal. The investors that you're raising from, I assume it's part of that network that you're trying to build. Maybe give a little bit of context on that and even
Sure.
the dollar value, whether, you had a 25K or 50K minimum and how you kind of worked out some of the mechanics.
Yeah. So we looked at capital raising in a really intentional way long before we needed to actually raise it, so we could put processes and systems in place, which is kind of the base of a strong, replicable business.
I'm going to give a shout out to Matt Faircloth's Raising Private Capital book here.
Totally.
His book was honestly the for a lot of the way we looked at that.
Yeah, we love Matt Faircloth's kind of structures. And so we used some of that and broke, we decided, first of all, that we didn't want to be raising capital on a per deal basis, because we see a lot of people that are raising capital, they have a deal, and then they go out and they start raising capital. We decided to have a consistent capital raising effort kind of year round, regardless of our current deal flow. And that way we could build relationships with investors and educate them at a comfortable pace. Educate them about syndication, about multifamily, about the deal structures, return profiles and targeting. So that way, when we did bring them a deal, they felt educated enough to make a choice and deploy their capital with us. So that was the first kind of thing that we did. And secondly, we broke our network into three parts: tier 1, tier 2, and tier 3. Tier 1 being our family and friends and closest colleagues, the people that we could that we see on a daily basis, or we go and spend the holidays with, the people that are just the most trusted and the most deep relationships. So we started by kind of bringing them in and telling them about what we were doing. The tier 2 are the people that we meet in maybe a networking type of an event. So we meet them at a conference or a meetup, or they're colleagues of ours from the past that we have or friends that we have a decent amount of relationship with, but maybe it's been a while since we've talked to them. So former colleagues or friends from college and things like this. So that was our tier 2. And with them, we began reaching out to them through kind of email campaigns, educating them about what we're doing through LinkedIn. And then, of course, just in our normal networking activity. And then tier 3 are people that we've never met before. So perhaps someone that's listening to this podcast right now would be considered a tier 3. And what they do is, hopefully they're energized to come and check out what we're up to because they like our story and what we do. And they come to our website and start engaging with a suite of resources. They get involved with our newsletter. And at that point, they're a tier 3. And with all of those folks, we then begin moving them through a funnel, essentially, that educates them, onboards them, and then asks them to commit, and eventually invest with us. And so that's essentially our structure that we use every day, week, quarter. And it's been going great so far. So yeah, big shout out to Matt Faircloth for that structure.
Yeah, that guy. I don't know if you guys can see
Yeah.
that.
Yeah, that's it.
Yeah, we did a deep dive in the book there. So what I hear from that funnel is you wouldn't be happening to be creating a substantive relationship with these individuals.
Absolutely.
Absolutely necessary.
Yeah, for sure. And so just on the financial side, whether you can talk to now or you can talk to when you first started raising capital, did you have a minimum investment, and what was that?
Yeah, our minimum has always been $50,000.
Okay. And you alluded to kind of having deployed capital ready to go. So did you create that in a fund structure that it was committed but not an actual funded amount, or did they literally fund the amount and then you had certain objectives to hit throughout the year?
It's a soft commitment. So essentially so of course, like their life situation can change, but at least we have them in a place where they like the types of deals we typically bring. And we look at our past performance to say, here's generally what we like to do with no guarantee of future results. But these are the types of assets we purchase. And so when a deal becomes available, we then ask them to actually deploy that capital into the deal. So it's just getting them warmed up and on deck.
Yeah, it's just a on paper commitment so that you have, I think a lot of the problem is, people are out there looking to do a deal, but they don't really have an idea of the amount of capital that they can raise, right? And so if you're constantly like talking to your investors and saying, oh, hey, if we had a deal, how much would you be interested in committing next time? Then you at least have some kind of idea on paper of how much you're capable of raising.
And I think, from investors I talk to as well and operators, it gets them in a psychological kind of mode that they kind of, they work out the objections that they have. You talk to them, what it means to be an LP and why, you're adding value to them. I think a lot of syndicators and just people raising capital in general, they think they're asking for their money, whereas no, you're doing them the favor. If you really believe in what you're doing, you're giving them an opportunity. Definitely. So taking us to where the team is today with Akras Capital, what does that look like? What does the portfolio look like? And I know you mentioned the geography a little bit. If you've expanded to other markets, would love to hear where you guys are at.
Okay.
Yeah, so like we said, we're focused on Phoenix right now, acquiring there. We have not yet acquired an asset there. It's a new market for us that we've been focused on since January. And then kind of the whole COVID thing over the last 6 months definitely slowed that process down a little bit, but we're back at it and we're actively, submitting LOIs every week. We've been best and final on a couple of properties that we haven't yet won, but we're definitely hopeful that in the next couple of months we'll be able to put something under contract.
Yeah.
So.
And the current breakdown of our portfolio is we have that Washington, 3 assets there. 2 of those are dispositioned and 1 remains. We're working to sell it now, have kind of active tours happening there. And then we have an asset in north of Orlando, Florida. And then we have, which is a 324 unit Class B. And then we have a 111 unit in Dallas, Fort Worth. So that's kind of the makeup of our current portfolio. And then, hoping to grow that in the Phoenix space.
Okay, great. Well, we are coming close to the end of the show here. I'd like to do a fast 4 final questions here. So if you guys are game for that, we can get started. And
sounds good.
In terms of, you kind of mentioned a little bit about kind of mentors, but are there a couple individuals that really kind of took your journey to the next level with real estate that you'd like to shout out?
Definitely. I mean, one of our partners in Dallas, Fort Worth, we met at the Best Ever, Joe Fairless's Best Ever conference. Well,
Awesome.
First of all, Joe Fairless and the Best Ever conference was a huge place where we started interacting with a lot of professionals in this space that were thinking really big, and that really started to elevate our mindset on what we could do and what our capabilities were. So, a shout out to him. His book was probably pretty transformative in understanding of syndication. So while we know him just a little bit, superficially a little bit, we've stood in some, photos with the guy. He was definitely someone who was really formative in our thinking about all this.
Yeah, he's got a blueprint. That book is, it's called a book. It really is a blueprint. It's pretty well done, to say the least.
Totally. Yeah.
I think that's it for right now.
Yeah.
I mean,
all right.
There's a lot of partners and folks that, along the way, from contractors to, property managers who just gave us little bits of advice and wisdom here and there. But one thing I would say that we're doing is putting together a strategic advisory board right now of 4 individuals who can help to provide us with operational and strategic guidance. And so we're kind of formalizing some of the people that were already mentors to us in a way that they just join us on our strategic offsites every quarter and help us give us a little bit more tangible guidance. So
that's great.
Yeah.
So in the next question is, it's usually about books that have impacted you. You mentioned 2. This can be, something that was transformative for you, whether it was related to real estate or not. Just 1 or 2 that really that you found was beneficial.
Yeah, so a book that's unrelated to real estate, but can absolutely be applied to it. I was given when I started my first travel business. Is called The E-Myth Revisited, and it's by Michael Gerber. And I feel like a lot of people in real estate know this book, but just systems and processes, turning your business into a replicable success, a little machine. That was a huge influential book for me as I started and grew businesses over the course of my career. Anything?
Yeah. So I'll give a shout out to, I just finished a couple months ago this book called Profit First. And for any new entrepreneur who is starting a business, I highly recommend it because it helps shift your mindset as an entrepreneur and why you should pay yourself and how you should be thinking about making that happen. And, just a really great read. So.
Awesome. All right. We got 2 more. And the next one is something you wish you knew when you started this investing career.
Okay. So I think it's just like what I wish I knew is like mentally preparing yourselves for the ups and downs of real estate. It's definitely at sometimes a little bit of a roller coaster. And that definitely took some getting used to. And so, I think I would tell myself 3 years back, like, just, it's going to be okay. There's a lot of ups and downs, and just, focus on your mindset and get to the right place. Yeah.
And that's a hard one too. I find, friends that I've had that have come to real estate from the financial world, it's one thing when you're dealing just with stress of a job. It's another when you're dealing with human beings and people and tenants and asset managers, property managers. That's a great answer. All right. The last one, just because listeners know I'm a huge car guy. Your first car, make and model.
Ooh, I'm a car guy too.
There we go.
First car was a 2000 Jeep Cherokee, kind of one of the classic ones before they retired that kind of
ruined everything.
And,
okay.
Yeah, seriously. that was my first car. I paid for it myself, and boy, I don't know where it is these days, but had a lot of fun with that thing. What about
That's
you?
awesome. We normally don't get cool. We normally don't get cool cars for the first one.
I had like a van that was really hideous.
That's awesome. Well, listen, thank you so much for coming on the show today. It's been a slice. It's usually when you look at the clock and you're at the end, that means it was a great talk. For people to reach out to you, Google your name. Is there any specific area you'd like them to reach out? We can definitely put anything in the show notes.
Yeah, I mean, certainly our website, Akras Capital, AKRAS capital.com is a great place you can go and connect with us. Sign up for our newsletter. We have a white paper that we feature there. And if you have any interest in getting involved with us, you can fill out an investor application, and that'll ping us directly. There's also links to schedule and book meetings with us independently if you like. You can find us on Facebook, Instagram, LinkedIn, all over the place. Yeah.
Awesome. We have people on the show that maybe a little bit older than us, www, and I'm like, guys, we'll put it all there. You're going to be able to find them.
Yeah, certainly. Feel.
Awesome. My guests today have been Charlie Stevenson and Kristina Knight. Thanks so much for coming on Working Capital.
Thanks, Jesse. It's been fun.
Thanks for having us.